The Psychology of Money, Timeless Lessons on Wealth, Greed, and Happiness by Morgan Housel, 2020. No one is crazy when it comes to money, because your personal experiences with money shape your perspective in ways that are completely rational to you, but may seem irrational to others. Housel opens by explaining that people from different generations, raised in different economic conditions, with different family backgrounds, will inevitably see the world differently, and this includes how they think about money. The Great Depression shaped an entire generation to be risk-averse and frugal, while those who grew up during prosperity may see risk differently. You cannot judge others' financial decisions because you have not lived their lives, and you cannot expect them to see the world the way you do. This fundamental truth underlies every lesson that follows, reminding you that finance is not just about math, but about behavior, and behavior is shaped by forces you may not even recognize. You must understand that pessimism is more persuasive than optimism because it speaks to our survival instincts, but optimism is what actually drives progress. Housel explains that news about things getting better is not as compelling as news about things getting worse, so you are constantly bombarded with reasons to be fearful. Yet over the long term, the world has consistently gotten better in almost every measurable way, from life expectancy to poverty rates to technology. This is the paradox of progress. It happens slowly and quietly, while setbacks happen quickly and loudly. You must learn to be optimistic about the future, while being realistic about the bumps along the way, believing that things will improve over decades, while accepting that they may get worse next year. This combination of optimism and resilience is the only way to stay invested long enough to benefit from the growth that inevitably comes. You must accept that you will change over time, and that the goals and desires you have today may not be the ones you have in 20 years. Housel shares research showing that people consistently underestimate how much they will change in the future, assuming that who they are now is who they will always be. This has profound implications for money, because it means you should avoid extreme financial decisions that lock you into a future you cannot predict. Saving more than you think you need is not just about having extra money. It is about having options when you inevitably change your mind about what you want. The key is to be conservative in your commitments and aggressive in your savings, giving your future self the flexibility to be whoever they turn out to be. You cannot know what you will want later, so do not trap yourself into a life you may not desire. Nothing is ever as good or as bad as it seems, and that the emotional extremes of greed and fear are the biggest threats to your financial health. Housel tells the story of the dot-com bubble, when everyone believed the world had changed and traditional valuation metrics no longer applied, and the financial crisis, when everyone believed the world was ending and the entire system would collapse. Both extremes were wrong, and those who stayed balanced through both came out ahead. The key is to have an investment philosophy that works in any environment, one that is not based on predicting the future, but on being prepared for whatever comes. You must build a portfolio that you can hold through both euphoria and despair, one that allows you to sleep at night regardless of what the headlines say. This requires humility, patience, and a recognition that you do not know what will happen next year, but you know that over decades, things will probably work out. You must be wary of the seduction of certainty, because the world is far more random and complex than you can comprehend. Housel explains that we crave simple stories and clear causes, but reality is messy, with multiple forces interacting in unpredictable ways. The most dangerous financial move is to bet everything on a single outcome based on a single story, because that story is almost certainly incomplete. You must diversify not just your investments but your thinking, seeking out contrary opinions and challenging your own assumptions. The people who succeed over long periods are not those who are right most often, but those who survive being wrong, and survival requires humility. You must admit that you do not know what will happen, and build your life accordingly, with margins of safety that protect you from your own ignorance. Room for error is the most underappreciated force in finance, allowing you to survive long enough for your plans to work. Housel calls this margin of safety, and it is what separates those who last from those who blow up. Margin of safety means saving more than you need, investing more conservatively than you think you can, and never risking what you cannot afford to lose. It is not about being pessimistic, but about being realistic about your own fallibility. You cannot predict the future, so you must build a life that can withstand bad luck, bad decisions, and bad timing. The people who succeed are not those who are never wrong, but those who are wrong in small ways and right in big ways. You must recognize that you are not your money and that your self-worth should not be tied to your net worth. Housel explains that the pursuit of money can become an endless game of comparison, where enough is never enough because there's always someone with more. The key is to define what enough means for you and stick to it, recognizing that beyond a certain point, more money does not bring more happiness. Enough means not just having what you need, but having the wisdom to stop before the pursuit of more destroys what you have. It means understanding that the goal is not to die with the most toys, but to live a life of meaning, connection, and contentment. When you know what enough looks like, you can stop running and start living. You must appreciate that everything has a price, but not everything that counts can be counted, and the most important things in life are often the hardest to value. Housel closes with reflections on what money ultimately means, arguing that its purpose is to give you the freedom to live life on your terms. The lessons of this book are not about getting rich, but about understanding yourself well enough to make decisions that align with your values. You must ask yourself what you really want from money and whether the path you are on will actually get you there. The psychology of money is ultimately the psychology of you, and the more you understand yourself, the better your financial decisions will be. In the end, the highest form of wealth is the ability to wake up every morning and say, I can do whatever I want today. Luck and risk are real and powerful forces that operate alongside skill and effort in every financial outcome. Housel tells the story of Bill Gates and his childhood friend Kent Evans, both brilliant students with equal access to computers, yet Gates became one of the richest people in history, while Evans died in a climbing accident before they could start their company together. The difference was not skill, but luck and risk, and you must accept that not everything that happens in your financial life is within your control. This is not an excuse to avoid responsibility, but a reminder to be humble in success and forgiving in failure. When you see someone wealthy, you do not know how much luck contributed. When you see someone struggling, you do not know how much bad luck played a role. The line between boldness and recklessness is often just the outcome, and you must respect that the same actions can lead to different results depending on forces you cannot predict. Being reasonable rather than rational is often the better approach to money, because financial decisions are made by humans, not spreadsheets. Rationality means making decisions based purely on logic and math, but reasonableness considers the human context, the emotions, the need to sleep at night. Housel explains that you should aim to be reasonable in your financial life, because reasonable decisions are sustainable, while purely rational decisions often break down when emotions intervene. It is rational to invest as much as possible in the stock market, but if you panic and sell during a downturn because you overextended, the rational approach failed. It is reasonable to invest a bit less so you can stay calm and stick with your plan through volatility. The goal is not to maximize every theoretical dollar, but to design a financial life you can actually maintain over decades, and that requires being reasonable more than being rational. You must embrace the power of compounding by understanding that extraordinary results come from ordinary actions sustained over very long periods. Housel shares the story of Warren Buffett, whose wealth is not just the result of good investing, but of starting young and living long, allowing compounding to work its magic for over 70 years. Buffett began investing at 10 and had most of his wealth after his 50s, showing that time is the most powerful force in finance. Yet people constantly chase shortcuts, trying to find the next hot stock or get rich quick, ignoring that consistent, unspectacular returns over decades outperform spectacular returns over months. Compounding is counterintuitive because it works slowly at first, then explodes, and most people lose patience before the explosion happens. You must respect that financial success is not about how much you make, but how long you keep it growing, and that time is the one resource you cannot buy more of. Getting wealthy and staying wealthy require completely different skill sets, and most people who achieve one fail at the other. Getting wealthy requires taking risk, being optimistic, and putting yourself out there, but staying wealthy requires the opposite: paranoia, humility, and a recognition that what got you here may not keep you here. Housel explains that survival is the only thing that matters in the long run, and you must design your financial life to withstand worst-case scenarios so you can stay in the game. This means having a margin of safety, being conservative with leverage, and never risking what you have and need for what you do not have and do not need. The greatest investors in history are not those with the highest returns, but those who survived every downturn and lived to compound another day. You must be optimistic about the future, but paranoid about the path, believing that things will get better while preparing for them to get worse. You must understand the power of tails, the idea that a tiny number of events drive the overwhelming majority of outcomes in any field. Housel uses the example of venture capital, where most investments fail, a few do okay, and a tiny handful generate all the returns. The same is true in your career, your investments, your relationships. A few decisions determine everything, and most of what you do does not matter. This should liberate you from obsessing over every small choice and free you to take more shots, knowing that most will miss, but the ones that hit will make up for all the misses. You must be willing to fail a lot, because failure is the cost of admission for the successes that change your life. The key is to keep the failures small and manageable, so you can stay in the game long enough for the tails to work in your favor. Freedom is the highest dividend money can pay, and that controlling your time is the single most valuable benefit of wealth. Housel argues that money's greatest intrinsic value is its ability to give you control over your schedule, allowing you to wake up and say, "I can do whatever I want today." Studies show that this sense of control is the strongest predictor of well-being, more powerful than income, status, or possessions. Yet, people often chase money in ways that sacrifice control, working jobs they hate to buy things they do not need, trading freedom for stuff. You must remember that the purpose of money is not to accumulate the most toys, but to give you options, flexibility, and peace of mind. When you think about financial decisions, ask whether they increase or decrease your control over your time, because that is the true measure of wealth. You must learn that you are not as rational about money as you think, and that your financial decisions are heavily influenced by the era you grew up in. Housel explains that the inflation of the 1970s shaped an entire generation to fear bonds, while the stock market boom of the 1990s shaped another generation to love equities. Your personal experiences with money, particularly in your formative years, create biases that you carry forever, and you may not even recognize them. This is why older investors often seem too conservative to younger ones, and younger investors seem too reckless to older ones. You must be aware of your own biases and seek perspectives from people who lived through different eras. History is not just the past. It is the force that shaped how you see the world, and understanding that helps you make better decisions. You must embrace the paradox that the harder you try to outperform, the more likely you are to underperform, because of the powerful role of compounding and the danger of overconfidence. Housel tells the story of Jesse Livermore, one of the greatest traders in history, who made and lost multiple fortunes trying to time the market perfectly. The most successful investors are often those who do the least, buying good assets and holding them for decades, letting compounding do the work. Trying to beat the market requires taking more risk, making more trades, and paying more taxes and fees, all of which work against you. You must recognize that in investing, as in many areas of life, doing nothing is often the hardest but most productive action you can take. The trick is not to be the smartest person in the room, but to be the one who can sit still and do nothing when everyone else is panicking. To show love and appreciation, like, share, and subscribe.